Gold in the blockchain. You've got the world's oldest, most trusted asset on one hand, and the newest, most disruptive financial technology on the other. Putting them together should be a perfect match, right? Well, it's not that simple. It turns out to be one of the most fascinating challenges in finance today. So let's get into it.
So what's the big problem here? Why can't we just create a digital token for every gold bar and just call it a day? The answer, it turns out, is a tangled web of global banking rules, brand new technology, and the very nature of risk itself. And that's exactly what we're going to unpack in this explainer. All right, our story starts with the biggest players in the game, the banks. You would think they'd be the first ones jumping at the chance to issue a digital version of gold. But they're facing this really strange and significant hurdle. You could almost call it a regulatory paradox. And here's the absolute core of the problem for banks. On one hand, regulators love it when banks hold physical gold. It's considered a top-tier, super safe asset. But the very second you turn that exact same gold into a digital token, a completely different, much stricter rulebook gets slammed on the table. It's the same asset, but in the eyes of the regulators, it's a completely different beast. That rulebook is called Basel III. You can think of it as the global safety code for the entire banking system, and it was designed specifically to prevent another 2008-style financial crisis. And while Basel III gives physical gold a gold star, it treats anything that's labeled a crypto asset with extreme caution. And this is the massive regulatory headache for any bank. A gold token has to jump through all these incredible hoops just to prove it's low risk. And even if it passes, the bank still faces higher capital requirements for it. Plus, regulators get really nervous about all the new kinds of risks that come with public blockchains. We're talking cyber threats, operational risk, even the potential for a digital bank run on the tokens. For a bank, the reward just doesn't seem worth all that regulatory risk. So if the banks are all tied up in these regulatory knots, does that mean digital gold is just a non-starter? Not at all. It just means the real innovation is happening somewhere else entirely. And here is the really clever workaround. The companies that actually refine, store, and sell physical gold, well, they aren't banks, and that's the key. It means that all those complex Basel III rules we were just talking about, they simply don't apply to them. They operate under a completely different framework.
The difference in their business models is just night and day. Banks are regulated with financial stability in mind. Bullion companies, they're regulated for handling physical metal, things like anti-money laundering. This means for a bullion company, a gold token isn't some complex financial instrument. It's basically just a digital warehouse receipt, a direct claim on a specific bar sitting in their vault.
And this model is already out there in the wild. Companies like Tether and Paxos have created some really popular gold tokens by doing exactly this. They act as the custodians for the physical metal. Each of their tokens is a direct claim on a real, audited gold bar. It's also pretty interesting that some of the biggest traditional players, like the super respected German refiner Hafner, have so far decided to stick to the physical world, which really highlights how new this whole space still is.
So, this non-bank model definitely works. But what if there was a way to create a token that was even simpler, even more secure, and way more transparent? Well, this is where a new development on the oldest blockchain network of them all, Bitcoin, completely changes the game.
I want you to meet the Runes protocol. It's a brand new, highly efficient way to create tokens on Bitcoin. And its biggest advantage is actually what it doesn't have: complex smart contracts that can be full of bugs. For an asset like gold, where security and simplicity are absolutely everything, this whole less is more approach is a perfect fit. A Rune token can carry all this rich, verifiable data directly on the blockchain. Just imagine a single token that contains a gold bar's unique ID number, its precise weight, its purity, a link to its official certificate, and even the rules for how you can redeem it. All of this information is embedded, transparent, and totally unchangeable.
This combination is a massive potential breakthrough. You get simplicity, which means you're reducing the risk of bugs or hacks. You get the rock-solid, fortress-like security of the Bitcoin network, and you get this radical transparency, where literally anyone can go and verify the asset that's backing the token. It's a really powerful trifecta.
Okay, so we've got a potential technological solution on the table. But, technology is only half the battle. What does the target market, we're talking Wall Street and institutional finance, what do they think about all of this?
For an institutional investor, risk management is everything. And when they look at these two assets, they see completely different risk profiles. A gold-backed Rune is stable. It's just tied to the price of gold. Its main risk is about the custodian holding the metal. Bitcoin, on the other hand, is highly volatile. Its main risk is the market itself. So they play totally different roles in a portfolio. One's a hedge, the other is a speculative growth asset.
This leads to a really fascinating strategic idea. A gold-backed rune could be the perfect risk bridge. It would let these conservative institutions start using the powerful, efficient settlement rails of a public blockchain like Bitcoin's, but without having to expose their balance sheets to Bitcoin's crazy price swings. It's a way for them to dip a toe into the future of finance without taking a massive leap.
Of course, this isn't a one-size-fits-all solution. While public blockchains like Bitcoin offer incredible transparency and global reach, a lot of institutions, at least at first, are going to prefer the control and the privacy of their own private permission blockchains. So we'll likely see a world where both exist. Public chains will be best for open, global liquidity, and private chains will be used for closed-loop settlements between a few big banks.
So we have the non-bank issuers. We have a powerful new technology. We have a really clear use case for institutions. So what's the one final piece we need to unlock this massive potential? Well, it all comes down to regulatory clarity. And this is where the U.S. Clarity Act comes in. It's a proposed piece of legislation that's designed to do one critical thing: end the ambiguity. It aims to draw a clear line in the sand, defining which digital assets are commodities, to be regulated by the CFTC, and which are securities, to be regulated by the SEC.
So why is an act like this so important? Well, because a gold token would almost certainly be classified as a digital commodity, and that provides instant legal certainty. The act would also create clear custody rules for banks and would establish regulated on-ramps for exchanges to operate. In short, it just removes the fear and the uncertainty that has kept so many of these big players sitting on the sidelines.
The Clarity Act basically provides the official rulebook for the game. And with clear rules, institutions finally know how to play, how to manage their risk, and how to stay compliant. This is the big green light that Wall Street has been waiting for.
Which brings us right back to our big question. We've seen the regulatory hurdles, the innovative workarounds, and the powerful new technologies that could make all of this possible. The path is complex, for sure, but the destination could be absolutely transformative, combining the timeless value of gold with the transparent, borderless security of a network like Bitcoin. Only time will tell if this digital dilemma finally gets its golden solution.